As the 1990s began, Bernie Madoff was running a legitimate and apparently successful brokerage firm with 120 employees and profits approaching $100 million a year. His firm was responsible for a remarkable 10% of the total daily trading volume in big board stocks and was handling 385,000 trades a month for larger Wall Street retail brokerage firms and giant mutual funds. As much as his rivals at the stock exchanges hated his practice of paying firms a small rebate for sending him their customer orders, academic studies showed that he still executed those orders at least as fast as anyone, and at prices that were as good as or better than customers could have found elsewhere. His order execution prowess impressed regulators and enhanced his firm's reputation. His sons were developing a small proprietary trading operation that made investments for his firm's own account, and his firm's software systems were considered among the best on the street. Behind closed doors, however, he was also running an immensely larger money management business, one that regulators knew nothing about. This hidden investment advisory operation was supposedly generating commission income for his firm and steady returns for investors whose accounts now totaled at least $8 billion. These included private investors such as Norman Levy, Jeffrey Pickauer, and Carl Shapiro, feeder funds such as those run by Stanley Chase and Walter Knoll, introducers such as Mike Engler and the brokers at Comad, and, of course, the legions of small investors whose money resided in a few large accounts labeled Avellino and Bienes. Madoff grew increasingly careful about concealing how wide and deep the river of cash flowing into his investment advisory business had become. He admonished his feeder fund sponsors to keep quiet about who actually managed their money. He cautioned private clients not to talk about how much business they did with him, or even that they did business with him at all. His caution reflected the fact that his split-strike conversion strategy, like the arbitrage strategy it replaced, faced inflexible size constraints. Only so many shares of the blue-chip stocks supposedly in his portfolio were traded at one time, and the number of shares traded was reported every day. Only so many options were traded on the public exchanges in Chicago, and the volume of those trades was reported daily too. So a legitimate split-strike conversion strategy could not grow endlessly large. The bigger Madoff got, the harder it would be for savvy investors to believe that he was producing an honest profit. At some point, there simply wouldn't be enough options trading in the public or private markets to hedge the amount of stock he would have been buying, and there would have been little chance he could really buy and sell stocks on the scale required without shoving the markets up and down in very visible ways. Still, his whole aura of success as an investment manager was that he never failed to deliver the returns his investors expected. He had brought them profitably through all the bad times, the market's tumble in 1962, the doldrums of the 1970s, even the 1987 crash and its rocky aftermath. No one knew that he had borrowed money from Saul Alpern to replenish his customers' accounts in his early years, and no one knew that he had been squeezed by a rash of withdrawals in the late 1980s. All his clients knew was that he offered steady returns even in volatile times, and they all wanted to invest more money with him. It was in this setting, he says, that his Ponzi scheme began. As long as most of his clients left their balances intact, rolling over their reported profits and making few, if any, withdrawals, he could pay out the occasional disbursement from the flood of new money coming in. It is the classic genesis of a Ponzi scheme on Wall Street. A money manager falls short of cash to cover some expense or placate some customer or deliver on some promise, and he steals a little money from client accounts. The rationale is always that he will be able to pay off his theft before it is detected. Perhaps this occasionally happens. Those are the Ponzi schemes we never learn about. More typically, the sum of stolen money grows much faster than the honest profits do, and the Ponzi scheme rolls on toward certain destruction.